Hello, Culture Matters podcast. Before I introduce my co-host for today, here's a quote just for this episode. It's not supposed to be easy. Anyone who finds it easy is stupid. Charlie Munger. Today, we are packed with Value Investor Series co-host Aleck Arena, the one, the only. If you haven't heard episode 221, 470, so many amazing episodes. Aleck Arena, actually 1003, recently recorded with an amazing guest. Aleck has been investing since well before he could drive cars legally in any state, most countries.
In Australia, we've just got one, but you can drive when you're 17 legally. There's no.
Thanks for
We're a
coming
country,
on the
mate.
show today, and we're going to try to paint a picture of where we're going with the Value Investor Series. If you've never heard of the Value Investor Series on the Culture Matters podcast, we've had some amazing guests internationally all over the world that focus on investing and have created unbelievable successes for that, not only themselves but their investors. And it's been quite a journey having these conversations with these investors. So Aleck, and of course Aleck as well, learning so much. I was just thinking about your quarterly update recently, and how I have so many questions from that segment that we did together. So informative and rich. Just the idea that someone could study securities, these pieces of paper, and walk away with so much interesting tidbits of information. Thanks for coming back on the show. What is
All good.
the Value Investor Series, Aleck?
Oh, I wanted to ask you separate questions first, Jay, mate. So
Please go on.
yesterday I said something, and Jay had a bit of a heart attack. So I just wanted to see how. Did you go to the doctors after we had a conversation yesterday? I mentioned the
I'm
EBITDA
still reeling.
slightly, and you
Yeah, I'm
you
still
grabbed at your
reeling.
chest.
I'm still reeling for it. If anyone doesn't know what is it? Earnings before interest,
For
taxes,
interest,
taxes.
tax, depreciation, and amortization.
What is depreciation?
Oh Jesus, I've never thought about that before. So like let's say I've got a laptop sitting in front of me, and that laptop depreciates in value over time. So the value of this physical item goes down. And because I'm working with it right now, I'm on a podcast with Jay Duran, which is a business related expense. In Australia, I'll be able to claim the depreciation on that. So effectively, some people would say your assets are losing value. Yeah, I don't know. Jay, I do some things very differently. So
What do you mean?
if I was to comment, like I think like a laptop's like a liability. So like a car's like a liability. So for me, your liabilities, when they lose value, sometimes you can claim that if it's for a work or a business related expense. Um, but some people would argue that they're assets, and they have a fair argument, because if you own a truck in a business and the truck's producing income, like obviously you've got a truck driver involved, you can argue that that's an asset. So I don't want to start the third world war about assets and liabilities, and I don't want people coming after me online. So yeah, I do sometimes think differently to other people. Like yesterday, Jordan said a house is an asset, and I didn't agree with that. Especially your primary place of residence, because you can, like, it doesn't produce any cash for you. Like your house that you're living in now, does someone, like, no one pays you for your house that you live in now. If you sell your house, someone will pay you, and they might pay you a higher price, they might pay you a lower price. Then you need to go buy a different house, and you'll buy, with the money you've got from the sale of your house, you'll buy a very similar house, a very similar level of house. Or you need to go to a much worse area and go buy that house. So there obviously is equity built up inside your home. And yeah, When you sell, you take that equity and then you go and plow that into another place. But it gets you about the same, it always gets you about the same type of house. So as your equity's going up, you're just kind of saving your purchasing power in the housing market, if that makes any sense.
Well,
So it's
it's
not like you can
that's
go and upgrade unless you want to move to like North Carolina or I don't maybe Kansas City. I don't sorry, I'm the most uneducated person possibly talking about American real estate. But if you went to go move to a cheaper place, yeah, maybe you'd have like a much bigger house, but you wouldn't be as close to the beach and you wouldn't be a stone throw away from. Am I allowed to say where you live?
yeah,
Do you have stalkers? You wouldn't be
yeah,
a stone throw. You wouldn't be a stone throw away from Naples. So yeah.
yeah.
I
Naples,
suppose
Italy.
if you can live anywhere. We didn't. The audience doesn't need to know where you live. So yeah, if you lived in Omaha, obviously you'd have a much bigger house, Jay, for your price point. But you probably couldn't go duck down to the beach, could you? Jay couldn't go see the Gulf of America.
So depreciation is a concept around how things are less valuable over time.
Yes,
And there's something to do with tax, how that influences how we're taxed in the eyes of these grander institutions.
that's why it's
So,
involved in EBITDA because it's it's as Charlie Munger would say, it's bullshit earnings. But I was using an adjusted version of EBITDA um, because the company didn't have a tax liability for a long time because they had a massive tax assets from previous tax losses. Um, so that yeah, that's why I was valuing the company off EBITDA because why Charlie Munger said EBITDA is bullshit earnings is because it's earnings before tax. So earnings before tax to Jay Durant and me don't really matter. Like Jay just wants to know his take home earnings. Like there's no point in working out his earnings before tax. And then it's earnings before depreciation, which is also bullshit because you should claim that, and amortization. So like the audience doesn't need to worry about amortization today, but all they need to know is that it is a really you wouldn't go and value a mature business on EBITDA. Like in a business like Apple, if you're valuing Apple on EBITDA, you're probably going to get burnt. Like, yeah, shares are so hard. They're so case dependent as well. So if there's a massive tax loss, yeah, you might do it. If there's heaps of one-off depreciation, or if for any reason the accounts might look lumpy, you might want to use EBITDA or something close. But as Jordan said yesterday, I think the best way to value a share is to work out how much cash it spits off.
mm,
Um, so yeah, that's I wholeheartedly believe that. And there's that one share in the portfolio, and there's multiple reasons for why I value it that way. And I won't always value it that way. I'm valuing it this year that way. In 3 or 4 years from now, I'm probably not going to value it that way. So it's going to be more like they're going to have used most of their tax losses, and it's going to be a more mature business, hopefully. Um, so yeah, if Charlie Munger's listening right now, do not shoot me. I was a good guy. I still go to church. I I still come to Omaha. I still go to church effectively. Don't come after me.
I'm deeply interested in the philosophical foundations of value and the spirit of value investing. The philosophical foundations of value, value theory, value, how that's represented in value investing. I think that's one of the most interesting things for me as a co-host with you in this series, where we are bringing world renowned, those that up and coming that may not have been or yet at this point, let's say known in the public eye, but have been operating within this construct of value investing for, long tenures. Those that are more well known, that might be generationally rooted, like some of our guests. Those that may even in the future uh, promote ideas that conflict or contrast the philosophy of value investing. But because like even just having these conversations, preparing for them, meeting with these guests, and having these open exploratory conversations, for me, it's it's like we're in time, uh, I guess piecemealing together like a mosaic, the mosaic of what value investing is, that it isn't aware that it is, what it is that it agree, those, the general public would agree with what it is,
Well,
what it
even Jordan
isn't.
said, yeah, what Jordan said yesterday is like there's many different ways how to skin a cat, and I think value investing, some people believe they're value investing and they're clearly not. Like Kathy Woods probably thinks she is, but she's not, or she's trying to promote that she is, so she can get like followers of Charlie Munger and Warren Buffett into her fund, but that's truly not value investing. And then you have approaches like Jordan, which is it's not always like this, Jay, but I'm generalizing, and generalizing is wrong. But I would say Jordan is in the growth at a reasonable price value investing. So he believes in high quality and a good earning stream over time. And then he talked about the payback periods yesterday. So that could be defined as value investing too. And then there's value investing if you'll go buy your cigar butt, you'll go buy your Ben Graham style investments, and the business is dying, but the assets are worth more than the business. And you're just sitting there waiting for the business to die. Or it's a cash box, so it's got more cash than its market cap. Um, it comes back to what Warren Buffett said is like, um,
Uh,
price is what you pay, but value is what you get. So, like, if I'm to buy a share, it might be worth less than the price that I bought it for, but might be worth more. So it's not the same. It's not the true value because the value of your house when you buy your house, that's not showing the fair value of your house. Your house could have been worth $100,000 less or $100,000 more. The true value is somewhere in between. Um, it's just like, and the hard thing with shares is you never know their future growth prospects as well. So if you value investing like Jordan, yeah, sorry, you want to ask a question?
oh no, no, keep going, I'll write it
If you
down.
do value investing like Jordan, you can have like let's say he buys a share like Nova Nordics, which makes Ozempic. Might look expensive on a P ratio at the time, which P ratios are not how you value shares, but like we're just using a hard and fast, dirty valuation. Um, so it could look expensive at the time, slightly, but as he touched on yesterday, they've done all this investing. Their products are superior to their competitors, and he believes they're going to grow more than the market in future years to come. That was back in the day, post global financial crisis. I'm I'm not like I can't tell you his thoughts on the stock now. I'm not don't want to put words in Jordan's mouth. So that's kind of the what I'm trying to explain there with value investing is that it could look slightly expensive, but then value investor also needs to work out what he thinks the future earnings are
Well, so
of the company.
let's play around this thought experiment, right? So like
Mhm.
what if there's a what if there's a there's different components. So for example, let's say checklist, mental models.
Mhm.
I am aware of, and I can conceptualize and put to action the mental models. And that is, let's say, I have a 20% chance that I'm wrong about my deduction and induction around the security. 80-20. There's instead of, because based on how deeply I am aware, how much I am aware of, how deeply I understand and can put to practice around the mental models, I'm 80-20, 80% right, 20% chance of being wrong. But that's just one bucket. Then you have another bucket, another component to the value investing philosophy construct, which is how I live. How I actually live in the world will bring me closer or farther away from 90-10, 10-90. If I live in a certain way, I'll be right 10% of the time versus 90% being wrong. And there's a weighting between the 10-90 or the 90-10 of how I live with the awareness of the conceptualization of and the acting out of the mental models. And then so let's say if I'm 80-20 on the mental models, I'm going to be wrong 20% of the time. But if I weigh that with being 80-20 on the how I live, that increases my ratio because now it's right, or it decreases it. Now we have another
Yep.
one, which is how long am I going to be an investor paying attention to value? Now, and that has a relationship with it, that has an influence over the compounding of wisdom as it relates to being aware of, conceptualizing, and acting out the mental models, and
Completely agree.
the strain on how I live. I don't have this. I mean, this is like some of the lessons that I'm learning from doing the show with you, or not lessons, but I guess like concepts
What you're picking up, it's
but like what the hell? Because have we met anybody in our life, or would we see anybody on TV or a book or one of these books on investing where they would say, "Oh, I'm not a value investor." What the hell? What is that?
yeah.
Anti-value? What is that? What isn't it an oxymoron? So the question becomes, what are we
No,
actually?
they're called you can see them on the internet, they're called growth bros. Like you can yeah, they're like
Please,
don't
can
think
you
the
can
crypto
elucidate
guys kind of
that?
fit into I don't think they fit into the category of value investor. What value are they trying to do?
Uh, if you
Like you can butt in there, but to me it looks like they're
no,
just
please help me out.
buying. To me, it looks like they're buying a just they're buying a digital currency and they're hoping to sell it to the next person for a higher price. And they have no control around the amount of units, or in the share market it would be shares. They have no control about the amount of coins that are going to come into supply, because there's more coins than supply, that market cap goes up. So in the share market, the company would be worth more, but in crypto, the currency would be worth more when more coins come into supply, which means this theoretically the price of the coins should go down. But if I suppose if there's more buyers than sellers, obviously price goes up, and then you can sell it to the next person at a higher price. But if there's more sellers than buyers and you're adding supply to the market, they're probably stuffed. But I don't know why I'm commenting on this. Sorry. You just
No,
asked
keep
me
going,
if you
keep
think
going.
there's investors that aren't value investors, and that's an area of the market where I would point out that they're not value investors. I think I don't know Palantir well, but Jordan touched on that yesterday, and I know it well enough to say it looks like extremely overvalued. So they're not value investors. You might come across some Momo investors, so like they're momentum traders. Um, they like buy a share because it's going up and follow like the kind of trend behind it, and then when the trend starts turning, they'll sell straight away. There's like uh, there's people that use algorithms to front run your orders, and they take a small margin on you buying a share effectively. So, and that's actually like I'll say that's a form of investing, but it's not value investing. Um, then there's AI driven algorithms for currency. For like if you're trying to invest in currency. So that's quite choppy. So when I mean choppy, like they're doing a lot of buying and selling, and the algorithm's shooting within like 1 second, 2 seconds. And sorry, when I said before that people try to front run your orders, so when I go to buy a certain share, they'll jump in front of you and they'll try to sell shares back to you and they'll try to get a small margin off you. That's fast too. If I'm sending an order notification to the Australian Stock Exchange, the Australian Securities Exchange, I always, ever since I've been a kid, 12 years old, I've always reverted back to what it should sound like, not what the ASX actually stands for. Um, sorry, I. Jay, I remember being like 13, sitting in economics, and like we were doing a test, and it's like, what does the ASX stand for? And it's so funny. Like, I got the New York Stock Exchange right. It's the only kid in the class that knew what the New York Stock Exchange stood for, right? And here I am. There's the ASX, right? And every kid in the class has put the Australian Stock Exchange, but it's the Australian Securities Exchange because they sell more than just shares. And I just like the teacher was like, kids, like, what are you doing, bro? It's like, Aleck, what are you doing? And I was just like, he didn't clearly the teacher didn't say it like that, but yeah, I was flabbergasted, and I still haven't learned. It's been 10 years, so so hopefully I've learned my actual investing. I've improved my investing in the last 10 years. But we were talking about different ways you can make money in the share market, and that's not all from value investing or how people think there are different ways they can make money in markets, not just the share markets. Um, so I would say like when George Soros goes and does some weird currency fucking trade. Oh, whoops. I should have. When he does some weird shit, right? I would say that's not value investing. Like when he's like he sees value in it, but a lot of currency is driven by a lot of macro headlines, and it's driven on a lot of times what people think. So if people think a country is going bad, there's multiple other factors, but yeah, it changes. It moves away. Like it makes the currency go down, it makes the currency go up. It's Currency is an extremely confusing thing. There's so many things that run into it, like what your country's cash rates are. So when the Fed moves rates up and down, that can affect your currency. How much gold you have in reserves as a country, and oh, how much debt your country has. So if you're America, everyone knows how much that number is. It's a really large number. Um, that's all over the news. People have various opinions about that. I have a different opinion about that to the rest of my peers, it feels. Um, and then if you're the reserve currency, your currency acts different again. So if you're the biggest, baddest boy in the room, people are scared of you. You when you move rates, when your 10-year yield moves, it affects your currency, but our currencies as well. Um, yeah, I don't know. Macroeconomics is like I know we're starting to dive into macroeconomics here, and I think I would need a lot more than an hour or 10 minutes to explain macroeconomics and my views on currencies. People would say that what I'm telling you is wrong. Everyone has a different view, and I suppose that's what makes the market. Um, but yeah, it. As I said, we could be talking about this for a long time. But your question was about value and why do people invest and they're not value investors. My idea was yes. I think people do invest and they're not value investors. Usually, people that aren't value investors will tell you very fast they're not value investors, and they think value investing slow and old and stupid. And value investing loses its way close to the end of a cycle. So like I don't know how to touch on this, but like a manager, a fund manager will usually underperform during the end of a bull market because everyone's going crazy. People are just buying stuff and just bidding it up, and stuff's going higher and higher and higher. There's so much euphoria, so much excitement. It used to be in the streets, but there's so much excitement online these days. Um, and they a traditional value investor can't go with the prices. They can't go with the shares. So they underperform the market, which creates a big problem for them. And the people that are making money at the top are not the people making money throughout the whole cycle. Because I think value investing is probably the best way to make money throughout a cycle. Um, yeah, I like there is other ways to make money throughout a cycle, but in the share market, not in the financial markets, in the share market, the best way to make money throughout an entire cycle is value investing. So you're getting back to those fundamental basics and going, am I getting a good deal here effectively? And then a lot of people like me think the management team is very important. Is the management team good or not? Jordan had a difference in opinion yesterday because he's dealing with much larger businesses. So he just wants the business to be of extremely high quality. And then he effectively wants a CEO which retains culture and helps the company culture. But I want a CEO that's going to be more hands-on. Jordan's buying companies that are worth tens of billions of dollars and hundreds of billions of dollars. And I'm buying companies that are worth tens of millions of dollars, literally tens, like not even hundreds. So a manager can have a lot more of an impact in my area than it does in Jordan's area. Um, yeah, so I feel like I've kind of explained that now. So yeah, people do make money in the share market without value investing, but in my belief, that doesn't last for a long period of time. And I think history showed us that it doesn't because you've gone back and you've seen like if if Jordan or I was running a fund, I'm sorry because we had Jordan on yesterday and like he's great. But if we were running a fund in 2001, Jay, we would be underperforming. If me and Jordan were running like I know personally, I underperformed in 2021 in my personal account because I couldn't make sense of any of the valuations. It was craziness. Like it just didn't make sense. Like right now in the Nasdaq, there's like MicroStrategy, which is a guy and he goes and buys Bitcoin. He has a company in America and they buy Bitcoin and they leverage to buy Bitcoin. And as the Bitcoin price goes up, they leverage more off their existing holding to buy more Bitcoin. Like it only works till it doesn't, you know? Like I can't I now I'm talking about the case specific and I shouldn't be commenting about that because I know those people would come at me, but do you get what I mean, Jay? I don't know.
Yeah,
I
I'm
I
listening.
can't really go too much deeper into it because I'm on a public forum right now. But if you're to keep leveraging on your returns, at some stage you're going to come unstuck. And if you're playing with leverage, that's a bad game to be playing. And like people that like use margin loans and shares and all that, it's very risky because yeah, especially in times like today, like it's not really the time that I would be using a margin loan in today's market, especially in America. And that's not financial advice. That's just my opinion. Um, and my opinion could be wrong, and it could be wrong for the next. I don't know how long my opinion will be wrong for. Um, uh, that's markets. Like I'm saying that a certain way because obviously someone could be listening to this and they're making heaps of money and they're leveraging doing it. And I've told them it's not a good idea. And the next 6 months could be absolutely amazing. But after that, the tide goes out and it's funny if I would have said a different word, but they lose a lot of money and that really hurts them. If the tide goes out, they'll lose a lot of money. And Jade, the tide will go out. We've seen that throughout history. The tide always goes out at some points. You could even say like I don't think we've had like a proper like recession downturn in the world like for I would say COVID was our last recession, which was not a normal recession. And then before that, it was like global financial crisis. But you could even see like 2022 rates go up, and it's the unwinding of this growth trade we had. So people are getting out of Tesla and they're getting out of like meme stocks and stuff like that. And there was a time and a place for value in 2023. Um, yeah, that's kind of what I'm trying to explain, that those bubble type areas aren't always safe to be in, but they can keep going up for a long period of time, and they can make active managers like me very frustrated, even though like I'm very lucky in a sense, Jay, because I'm agnostic to all of this. Like I wake up, I walk to my computer, I open the ASX announcements, I make money, I lose money. Like the noise in a day-to-day period doesn't really affect me. And then I do some research and I buy shares. Like I've really made it a lot more simple to that, but it's fundamentally driven. And Jay, I'm not trying to outperform an index. Mainly, most of my investors are family or friends. Um, and effectively, what I'm trying to do is take the least amount of risk with the most amount of reward. And for me, the scoreboard isn't behind my head. Jordan has a scoreboard behind his head. Jordan's trying to outperform an index. And for me, if I underperform an index for a year, my investors aren't going to be banging down my door. If I outperform an index for a few years, they'll be happy. But yeah, my goals are different to Jordan's, and it makes it a lot freer for me. Like it's easier to operate how I operate. Um, some people don't like it that way because they want outperformance to the index, but my idea is that I'll outperform the index long term because I take a longer term approach because I'm not playing the same game as everyone else. I'm not benchmarking to an index. Everyone else is just trying to outperform the index. And when you have people that are trying to outperform an index, they go and they sorry, which is good. I think my battery's about to run out, which isn't good. But they go to an index and they go like in America, Apple is I don't know. Jordan talked about it yesterday. There's your like Magnificent Seven, right? So there's your big shares: Apple, Microsoft, Nvidia, Meta, Amazon, Tesla. They a large proportion of your index, and big funds and super funds will have a target of outperforming the S&P 500. So what they'll do is they'll come along because it's a business. Funds management at the end of the day is a business. Maybe not for me, but it is for everyone else. So they want to try to keep their investors. So how do you keep your investors? You outperform the index or you underperform it really by a fine margin, but then you take a fee. So what they do is they'll buy every share in the index, and then they will weight those shares slightly differently. So if Apple's 8% of your index and they're really bearish Apple, instead of not owning it like I would do, they'll own 6% of Apple in their portfolio. And if they're really bullish Microsoft and it's 8% of your index, I'm throwing out random numbers here, they'll own 9% of Microsoft. And then if they get those calls wrong, they'll underperform. If they get some right and some wrong, they'll still perform in line with the index. What it leads to is underperformance over a period of time. But it's sold as active management and it's slight underperformance over a long period of time. So your investors are happy to stay with you because at some stage it has to turn. And maybe once in every 4 or 5 years, these managers their cards will come up and they'll have all aces. So they might be able for that year, they might be able to beat the index by 1 to 2%. And their investors will be really happy. And that should keep most of their investors invested for the next 3 to 4 years because they have had outperformance. So then they can point to the outperformance. Also provides a really good time to get new people involved into the fund. So they will go, hey, I outperformed. They will advertise a lot throughout that period to try to gain new investors.
This
And
seems
that's,
like an overemphasis on the instrumental value of the manager and an under appreciation of the intrinsic value of the manager.
yeah,
What I mean by this is like, think of intrinsic value as the real worth, right? Okay. So in the company terms, it's like cash flows, brand, culture, people. Instrumental value is market price, which are reflect what people are willing to pay right now. The instrumental value of the manager would be what's aesthetic, it's the ends, it's not the means. It's not taking into account absent the manager, what's the self likely to do absent that governor? Well, the self, the individual, that is their core competency is whatever derives their capital is not necessarily capital allocation. In fact, it's unlikely to be capital allocation. So how will they intrinsically react, behave, relate to the unknown, which is things go out of their expectation? So for example, the market collapses. How are they likely to behave absent the manager? Well, statistically, they're likely to make all the wrong decisions because now it's a temporal conversation. What makes sense rationally to do in the short term is to sell everything, but they have to be irrational. They have to not do all of that because meaning
yes.
survival is everything. They have to actually have faith and they have to do nothing, which goes against all how reason will relate to the unknown. And ultimately, they won't get an index return because their behavior will contradict the temporality of the investment, which is to not do anything and to wait for things to come back. And they won't get an index return. They will get a return far lesser than the index. Although, on a graph, it would be hard to model that, right? It would be hard to model that. All the models will show that the index beats everything most of the time, but what it's not taking into account is the intrinsic nature of the human being and how the human will relate to the unknown, how the human, absent the relationship with the manager, the consigliere, the advisor, the patriarchal matriarchal figure in the way of their decision, their reactive human nature decision to buy high and sell low. Like we can all drown in rivers that are an average of 4 feet.
Yeah.
So what I'm trying to say is, I think the whole general theory, it's not taking into account the intrinsic value of the manager. It's taking into account the instrumental value of the manager.
Well, you were just touching on
So
effectively passive investing, mate. And then the like you also effectively
passive
have
investing is an
managers that are passive
oxymoron.
investing.
Well, it's okay. That's another conversation. We should go there too. But I want to make this statement that passive investing is an oxymoron. And this is why. How are you defining that temporally? It's passive until it isn't. Meaning when
Okay.
everything is going great, when everything
Mhm.
is on the up and up, or nothing is changing and there's no anomaly, it's passive. But as soon as there's anomaly, as soon as there's change, the individual, the individual is going to react to that change. They will go from passive to active.
Okay.
Now,
Um,
see what I'm saying?
I
Like
think I'm gonna
the
fix this.
reality. the reality, like the likely reality of the passive investor is that they will become active in the face of change.
Of the
In the
worst moments.
they'll have to be
Wait, Jay. I
they only
genuinely
have to
think
be
I can
active
fix this for
once.
anyone that's listening.
One time. That's it.
Okay.
Sell low.
I advocate for passive investing. I'll come out and say that, okay?
I'm not making an
Okay.
argument for or against
I
either.
understand
This is a
Jay's point.
philosophical
I
conversation.
I clearly understand Jay's point. Passive investing creates problems for me. That's true. But if you passively invest over the long term, you do extremely well over a really long period of time. And obviously, the longer you hold, the longer time that your money's at work, which means you get a bit of a tax break as well, and that helps compounding. But
Yeah.
if you're a passive investor, chances are Jay's correct, and you will sell your shares at the worst time. So if you're listening to this, I'm not a fan of The Wolf of Wall Street at all. Hate the movie. I hate the movie. Hate its guts. But I think there's a scene where Jordan Belfort stands up and says, "I'm not fucking leaving." When you're going to sell your passive shares and the global financial crisis, you're in the middle of it, you're going to sit there and go, "I'm not fucking selling." That's what you have to. That's what you have to think. That's what
No,
you have to
Alec,
stand
the
up and do.
best passive investors are dead investors because they are beyond space and time. Their index can only grow. They're not in the way of it. The best passive investors are models. They're the models, not hand models, not aesthetic models. The
Jay, I was
freaking
trying
model,
to
the
save
financial
people, mate.
models. All right, I'm gonna be quiet now. Go on, please, please.
No. I understand what you're saying. I was trying to save people. Like, I feel like my brothers and well, sorry, wow, I made another family over there. But my brother he's successfully been able to passively invest. He's not sold at the wrong times. And I know other people that have done the same thing. So I do believe in it. Yeah, if they have a financial therapist to hold their hand during a hard time, like if the average person has that or not, they don't. Um, but yeah, I would do take what I said beforehand that you're not selling. Do not sell in bad times.
All right, so now that poses another question though. For those that are but here we go. Going back to the checklist, mental models, how you live, and how long you live. And we don't have all the components here, the variables of the value investor, but because you and I haven't unpacked that. But if the awareness, the conceptualization, and the activity of the mental model checklist, the mental models that are necessary to be aware of, to conceptualize, and to live out, that's a component of value investing. Another component of value investing is how one lives. So that's how one relates to the unknown, how one relates to change. And then it's also how long one lives. What if those that consider themselves passive investors, which
Mhm.
I still argue that, because if they're not deciding, if they're not doing anything, they're still doing something, which
Doing
is
something.
nothing.
Yeah.
Yes, because the word decide means cut off. They're actually, that's their
Not
activity.
participating.
They're not participating
Yeah.
when their neurophysiology is alarming and saying, you know, you better take a look at that predator. They're not. So um how they how they
I was
live and
laughing because
how
there's
long they
predators near
live.
your house, mate. Genuinely got me killed in Florida.
That is true. So is there a spirit of value investing? Because I in within the construct of the passive, right? The 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 perceivably passive or the linguistically passive, investor. What does that even mean? That's someone that is in the spirit of, I'm going to not use this
Sit
resource
on my hands and do
today.
nothing.
It's going to be going into tomorrow. They're investing into their future. They
Yeah.
have a relationship with their future self. I don't want it now. I'm going to take it later. I I don't know if you could maybe speak to that a little bit.
Well, you've just described investing basically. So I think that's important for the audience to understand. So you're trying to get a greater return than you currently have, and you're not 100% sure that you're going to make money in the future. So you discount that. Um, uh, what Jay was touching on is that, yeah, passive investing it's a form of actively investing because you're actively choosing to do nothing. So Charlie Munger says, like, you buy something good, like Berkshire Hathaway, and you sit in your fucking hands. Um, I'm sorry for the amount I've sworn in this podcast. My mom's gonna kill me, but that's effectively what he said. Um, Now I'm not advocating to buy Berkshire Hathaway shares at all. Yeah, I'm not a financial advisor, but if you bought an ETF over a long period of time and just sat in your hands and you didn't sell in the global financial crisis, you did pretty well. Now there is times where you can outperform an index by choosing an active manager. And I'd want to make sure the active manager is doing something like Jordan's doing, not like what I was describing before when a person index hugs effectively, when they're weighting slightly less to slightly more. And I'm not advocating for Jordan. I was just using Jordan as an example because how he's described, how he's invested, how he invests on the podcast currently matches the description of a truly active manager. And I think the amount of active managers in today's society are dying from an
Mm,
institutional standpoint. I think they're dying off. Yeah, that's like also like there's a lot of people giving it a crack and all that, but like I just look at the Australian like super system and most of the money that goes into the super funds, they're just passively, well, they're actively trying to index hug and taking a fee for it,
mm,
which I think we would have just been better off as an Australian country just making everyone buy an ETF. And like I fully um I fully I don't know how to say this. Recently in America, I saw the initiative that like the Republican Party has contributed $1,000 to every newborn baby. They're going to put $1,000 into the S&P 500 so they can be ready for retirement on the date of their birth. And I think that's very smart, an amazing government policy, and it it helps educate people on the power of compounding. When you're giving people $1,000 investment to the S&P 500 and you're trying to get them to hold it for 65 years. I think over a long period of time, they'll come to a very decent return. I think that with the Australian super system, I think it should have been set up more like the. I don't agree. I think that in Australia, we're forced to contribute 12% of our wages into our 401k. Your employer does it for you. And they're mainly managed by institutional investors in Australia. And they index hug, like I've touched on. And in America, you guys mainly do more active management and you're not forced to put money into your 401k from my understanding. So I think that you should be forced. I do think we've done a good thing in Australia with forcing people to do it. So I think they should have enough money to self-sustain themselves in retirement. Now, do I think how the Australian system's set up with how we're actually investing that money is correct? No, I think it's incorrect. I think we'd be better off doing the American approach of making people buy an ETF because they would save money on management fees and they would outperform these bad active managers over that time because they're really not active managers. They're just index huggers and business people. That's all they are. They're there to take a fee and to outperform slightly and to grow their funds under management. That's what the super funds in Australia are here to do. And if you're going to do that, you're better off being a passive investor that's actually going to hold through multiple cycles. That's what I was trying to get. So I think the American system's wrong, and I think the Australian system's wrong, and I think what we should do is somewhere in between.
What if certain personalities and certain temperaments would, meaning in one person, having that third party be there to stop them from being irrational, or really it's not irrational, it's being rational. That's backwards. Because it's
Yeah,
actually rational. It's rational to preserve what you have when things are going crazy. You don't know the future. It's irrational to actually buy into the culture and wait and do nothing. It's funny. That's even probably backwards. But certain personalities might do better with the manager who's more of a psychological governor, or let's say an extension of conscience, or an intermediary between the individual and culture, like past and future. That's the value of the managers, to stop you from, they're incentivized to stop you from buying high and selling low, or at least if you're not buying yourself, you're selling low because things are going to go down. And now you're calling your manager. You don't talk to them ever. You only call them when things are
but
down and you tell them to
in
sell. So certain people would really align with that. Other
yeah,
people, it wouldn't work for them, wouldn't matter. And it's not really helping them. And they're better off doing it themselves. Like you're saying anecdotally, your kin, that
yeah,
they have the constitution where they don't need the big brother. Well, at least up to this point, past performance does not dictate future performance.
okay,
But like
right.
they, it's like
I
to
like
each
it.
their own. Maybe a percentage of people fall in one bucket, another percentage of people fall in the other.
Like, sorry, if you just
I
cut
just,
out there.
I don't
Okay,
think we're taking into account the. I don't think we're understanding the. I don't. I don't I don't see enough conversation around the intrinsic value of the manager as a as a as a as a mirror of the self. Like, because there's an individual and then there's the manager, and how they relate to one another makes the whole. And we're always focused on instrumental value, what their returns are, what their cost is. It's not the intrinsic value of, take them out of the equation and the person destroys their life.
can I have a go here? Because so in Australia, when we're forced to contribute, we're forced to effectively.
Hmm.
You can self-manage it, Jay. From an economical point of view, your balance in your superannuation needs to be kind of high. Or you go with you go with a super fund, like in an institutional type of grade super fund, and they can't give you advice under the law, Jay. So if you call them up and ask them, should I sell, should I go defensive at the worst possible time in the market, they can just say, they can't say no. They can't talk you out of it. They just have to say yes.
Hmm.
Do you get where I'm coming from? So
Yeah,
where
why is
they're
that
getting a
though?
fee from, because they can't be liable to be seen to give you financial advice because they're not financial advisors. They're not financial advisors, they're investors. So different. It's like me and a financial advisor. I'm not the same person. I'm an investor. They're a financial advisor. So we're pulling in Australia, we're giving money to a bunch of people like me that are more business minded that take a fee for mimicking an index and underperforming it. And then if the global financial crisis comes around and you see your bank balance going down, if you see the balance in your 401k going down or superannuation, then you call up your fund and you ask them to pull it all out in cash and put it into bonds and like safe financial instruments. And then the market rebounds and they get smashed. Those people get smashed. They don't get the uptick. They get a big downtick. And the super fund has to say yes. So they're not paying licensed financial advisors. They're paying people like me to do a shit job. So I just plain and simple, in my belief, they're paying people like me to do it because they can't hold their hand, Jay. They can only invest their money for them and give them options of where their money should go. Options. And these are labeled options. It's growth. It's it's like defensive, and there's like traditional 60-40 portfolio, which is like you kind of, but it's between defensive and it's between growth. And I've heard a lot of horror stories of people rotating out of high growth in a bull market, and then a bear market comes around, their balance absolutely shit, like it goes down lots, and then they go into defensive and they miss the uptick. And this keeps happening. There's lots of money lost there. Because right now they're going into the shares, piled into shares like Nvidia, Palantir, all the high growth stuff.
I
And
think
then when the
that's where,
market goes down, they're like,
okay.
let's get defensive as. And the market rebounds back up as a whole and
But this is
rebounds.
where I think ontology comes in, which is how the person lives, okay, and how long are their timelines. Now, the timelines fall under pressure relative to how, like, where their capital comes from, what their relationship is to capital, what their relationship is to where the capital comes from. Is it coming from an institution, coming from retail, coming from themselves, some party outside of themselves? Then it's a conversation of leverage and margin. And because with every party outside of the self is another level of accountability that stretches the individual's ability to respond. It stretches, Confucius, man who chases two rabbits catches neither. We have to be careful of over diversifying our attention because that impacts our intention, our ability to make a goal, put our word on it, which is, it impacts how people perceive us, our reputation. It's a call to character. Like, the more parties involved, the more the individual gets stretched and can't, because there's only so much space that one can occupy. Like, you can't do two things at the exact same moment in time. You can do one thing and then the next thing and then the next thing, and each thing one does, right, has a goal, stakes the claim, and then moves to execute, takes energy. So you literally run out of calories. And like, there's only so much energy. Hold on one second. We were supposed to talk about the future of the value show, but I guess implicitly we are talking about the future of the value show. We're gonna have people we're gonna have people on the show that tell us what they think value investing is.
Yeah.
And we're gonna figure out what they're really up to.
Always handy having people on the show so it doesn't turn to this.
Oh, that's funny. That
Yeah.
is really
Hopefully
funny.
we have some big name guests coming up for you.
Man.
Yeah. What
I
else are we
just want to
supposed
go
to
back
cover?
to this ontology thing real quick, because
Yeah.
meaning how the person lives and their timelines influence what if how they live and their timelines influence have an influence over how they relate to the chaos. Because you were just saying before I went on that tirade that the moments of opportunity tend to be counterintuitive. People relate to them counterintuitively.
Yeah,
They,
you said it throughout this podcast. Yeah, it's people think right now the share market's not pricing for that much risk. When times are good, we don't, as human beings, because we make up the share market, it's not priced by aliens. We price risk poorly. When times are bad, we price risk very, very well. We overprice risk. So there's bigger opportunity when times are bad at the bottom, closer to the bottom, because it's priced in every possible risk nearly. It's priced in so many risks. Right now, we're priced for smooth sailing times with over leveraged markets and some people making some really dumb decisions about valuations on certain shares. And they're hoping that the shares go up so they can sell them to the next person. Remember what Jordan said yesterday? He said common sense is cyclical. We're in a time where common sense is now becoming cyclical. People don't have common sense at this time in the cycle.
well, I mean, what relationships does common sense, doesn't common sense infer a unified morality, like a clear, like an implicit agreement of what we agree with? Like we're in a time in the world where
Yeah, yeah,
it's much is left to interpretation, and there's tremendous independence of volition, or people can say and represent themselves in whatever ways they feel they can. And I'm not making an argument whether that's bad or good. I'm merely elucidating on this, or describing what seems to be the case, that we're in a time of uncommon sense. I say no, it's not common if it's reduced to the individual. Each individual has their own subjective experience and is, dogmatically representing that, like, this is who I am, this is what I believe, this is how I'm representing myself in the world. Well, what's common? The only thing common is how uncommon, how commonly
common sense
uncommon
is.
each. So, what does common sense mean? That's what I'm trying. Like, common sense, there's an agreed upon, there are enough agreed upon norms to where there's like a
Yes,
clear framework.
boundaries, norms.
but
Yeah.
but there isn't in this time, right? Time of excess, time of abundance, time of entitlement, because there's many ways
Well,
that we can represent our personal realities in the world. That,
can can I
like,
just get
God,
this
yeah.
straight that there is common sense like on the roads? We're just saying there's not common sense in financial markets this time. Do you get what I mean? Like we're saying
I'm
you
just
could
not
probably
sure what
argue
common
that
sense.
there's not common sense in society at the moment, but that's a
But I
you
think that
argument.
has a
That's not.
relationship. I think that has a deep relationship in markets. I think markets reflect, because what people seem to glaze over is the deep relationship with philosophy, like how people choose to live, how institutions are constructed, how that influences each unique culture, and how the people pursue life, right? Pursue life's meaning, how they pursue their motives, how they work, how they save, how they spend, what they spend on, like all of that. To me are questions of value. It's and speak to the core of what value investing is about, which is, what are the mental models? How do the people that actually say they do it live? And how long are they in that business? Like Warren and Charlie own the market share because they started in the beginning and they never stopped. They are value investing.
They didn't
Like,
start in the beginning, but I get what you mean.
well, in the sense that, first of all, it's like value investing classic is like Christian, it's like Nietzsche on Christianity, where he says
I'm
Christian.
sure there was value investing back in like ancient times.
I, 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 I-
Dude, you just
we should
bought a
look into
vase
this.
or a
Look into
cow and
this.
sold it for more expensive. Like you knew the cow was fundamentally worth $400, like
But
$400.
in the genealogy of value investing, isn't it essentially Benjamin Graham was a speculator? He was a polymath, mathematician, liberal arts guy who lost his ass in the in the recession in the Great Depression, and said,
So
I better use more math and less induction and more deduction. Like I have to use logic, right, to look at the math of the companies, what they're earning. Like that was the
yeah,
founding of. You have a guy that was pretty like likely a bit manic
that's modern
depressive.
day value investing in the share market, I would say. That was the founding of the modern day value investing in the share market. Before that, I reckon there was value investing. It was just different. Like you can't go and like there would have been someone out there
I
buying
actually
a
think
property.
value investing might have died with Warren Classic. Charlie Munger killed value investing. What if Charlie
No,
Munger actually killed it? What if he killed it?
yeah, he killed the first iteration in the share market because he was right. He didn't kill it. The Times killed it because markets became efficient to their theory. Do you get what I mean? Like when
Hmm.
Howard Marks was playing with options, and then after a
Oh,
long period of time, everyone figured out what he was doing, and he couldn't make any more money out of that way he was making money because the market had become efficient. They caught on to what he was doing. Now people have caught on. People, computer programs, everyone's caught on to what Warren and Ben Graham were doing back a long time ago. And now most people, most modern day value investors are doing what Charlie Munger was doing, like what Charlie Munger told Warren to do. But I'm saying value investing didn't start with Ben Graham. There was a person that bought a farm in the 1800s, I'm sure of it, and they had like multiple cows on the farm, and they thought they could kill the cows, send them to the market, make a 20% yield on the farm, and then they could make more cow. That sounds stupid, but they could breed more cows and then sell those cows and make a good yearly return. And then with that, I'm sure they went and they bought a secondary farm, and that was value investing. So value investing didn't start with Ben Graham, I believe. Value investing's been around long before Ben Graham. Like, trust me, there would have been entrepreneurs doing a version of value investing long before like the
I
1800s.
I like this might be helpful for our listeners. Comments, and by the way, I should maybe now is when I should just apologize to everyone. I don't know why that's funny to me, but this has been fun. Here's some general definitions. Common sense, the collection of basic shared beliefs or intuitions that ordinary people rely on to navigate daily life. So, for example, fire burns, water is wet, people need food. So, it's what we assume without needing proof. Aristotle talked about common sense, coin aesthesis. I'm not saying that properly. Describe the faculty that unites the five senses into a coherent experience. Example, knowing a piece of fruit is both red, which is sight, and sweet, which is taste, as one object. So that's like common sense. Thomas Reid in the 18th century was a Scottish he's had the Scottish common sense school. Common sense equals self-evident truths everyone accepts, e.g., an external world exists. Our memories are generally reliable. So it's interesting on those examples, they've been disproved up to this point. He opposed skepticism by appealing to everyday reason. Common sense in modern use equals practical judgment, not based on theory, but on experience. Um, So, yeah, common sense is the unspoken assumptions people in a group share. The problem, what seems like common sense in one culture, company, or era might not be in another. So what are your thoughts, Alec?
I reckon we've probably lost the audience by now. But yeah, I think
No, I think there's some people hanging on. I could see Nathan Merrill really into this conversation. Shout out to
I
my boy Nathan.
I can yeah.
Maybe
I think
Dimitri Stakias.
I think common sense is important. Um, yeah, and I think it's important even way past value investing. I think it's important in life. Sometimes I lack a bit of it, but yeah, I think you explained it well, mate. I don't really have too much to add, but it's a fabric that holds together society, kind of. Um, I think religion also tries to hold together society as well, but we're going a bit too deep into that now.
So
And
in closing, I want to ask you, as a, a big piece, a huge influence over the Value Investor series. What do you want our listeners to know is to come for the next, for 2026?
I haven't thought about 2026 yet, sorry, but hopefully more of the same. We get some really interesting people on the podcast and we keep growing it. And yeah, hopefully we create more value for you, the listener. Um, but I think it would be like a similar message from everyone, I guess, if I'm being honest, because they're all mainly they're not cut from the same cloth, but they're all from very similar, they all have very similar ideas. Um, they all think value investing is a very similar thing. They all have diff, they all have differing opinions based on based on what's happened to them in their lives and what shaped their thought of thinking. Um, yeah, I think it'd be really interesting for the listener in the next year, but yeah, we'll see. I'm really excited for it. Hopefully, we can keep going, keep getting great guests. We can keep getting some of our guests that we've had on back. Yeah, I think it'd be awesome.
I think give a shout out to our awesome guests. So we've had Luke Winchester, Chris Davis, Jordan Svetanovsky,
Steve Baxter.
Steve Baxter.
I think we're done from there. We had Aleck Arena. He's all right.
Yeah, a couple times. And we have some really great, yeah, we've had a lot of people back, which I think is awesome.
Yeah, obviously, yeah, we're really excited to have Rob Milner on. I think the 27th of October, that should be really good. And hoping to make that a two-part series. I think he'll create a lot of value for people that listen to the show. Obviously, he has a decently inspirational life story and definitely had some fortunate life circumstances. But I think he's a great Australian bloke, like a great Australian guy. And I think he kind of maybe represents or fits in with the um, country American ethos too. I think that's the audience that he'll relate to. The kind of simple, go about their business type person. He'll relate to them. So I'm excited to have him on.
Alec, this has been a blast covering some of these more philosophical concepts, and um, I'm excited to keep learning with you, with our guests. And I would say to the listeners, we have such a wide variety of guests on the Culture Matters podcast, but I believe it was Munger, or maybe both Munger and Buffett, that said, studying investing can make you a better business person, studying business can make you a better
Yeah, I think that was
investor.
both. I've heard Warren say it a lot, but I think I've heard Charlie say it as well.
So, why even go into why have a value investor series on the Culture Matters podcast? And I want to
Wait,
say, go ahead.
you
Sorry.
know why that is, Jay? Because I think a lot of people don't understand what Warren's talking about, and they're like, oh, so I should put people in I should put money into the share market so I become a better business person. So what Warren's trying to explain is that when you're in business, you have to always think about how you allocate your capital. And putting money into the share market, you look at your rate of return that you're reinvesting into your business. And obviously, if your business is growing faster than the share market and you're getting a good rate of return on your money, you keep putting your money into your business.
Mm,
And you shouldn't be investing your money elsewhere. If there's
mm,
more attractive returns elsewhere that have been risk adjusted, then you go and you put money elsewhere. And I think Warren showcased that he can do that really well, obviously, because he can convince business owner, he can convince companies that he owns in his portfolio completely outright to allocate their capital, to give their capital to him so he can allocate it at a higher rate of return. And
mm.
he showcased that, and he's got many levers to pull, obviously, because they're that big. They can buy a private business, they can go put the money into the share market, but obviously he's always trying to find the most attractive rate of return. Um, but in business, when your business is making money, it's very important that you allocate that money correctly and the most efficient way. Um, yeah, that's what Warren's actually trying to say. He's not trying to say that you will learn lessons in the share market,
Correct.
because the average
Correct your
person I don't
message.
think will.
I want
The
to
average
speak to
person
that.
doesn't read the financial reports. They don't do all that stuff. But they should go, if you go have a quick look at return on capital for a share, like let's say Costco, and you go over a 60-year period, the growth rate of the share should be close to the return on capital, barring some black swan event, which could happen. And if the return on capital is higher in Costco or some random share, you're probably better off allocating to that stock than you are allocating to your business. If it's only if when you allocate that money to your business, that it's returning like 2% or 4% or 6%. Buffett's mental model around capital allocation, he's usually trying to target around a 20% return.
And that brings us to culture matters in the sense that, okay, we're having conversation around value. What is value? Well, value, what if value comes as a consequence of va values, which which are revealed in how we work together, how we live. Every business owner or business operator, someone involved in business, is it has a goal and has a story that they're or a set of stories that they're acting out towards that goal. And how we work and how we work together reveal what we value and what core values are in a sense in the operating system of our character. And uh you mentioned something about asset allocation, right?
Yep.
The
Capital allocation.
capital allocation, capital allocation to allocate what is that is that's a call to thought thinking, which now is a conversation for, if anyone listens to the 30 Days of Thought and Friends, that's a call to fundamental reading, writing, speaking, listening,
Yeah.
fundamental learnable skills or behavioral tendencies or
Trying to get the person to think about
rituals.
what they're doing.
Yeah, and at
Have a
each
deep think.
person,
Yeah.
no matter where that they're in business, life, you could, you reading and writing and speaking and learning how to ask questions and some of the fundamental lessons that people learn on our show, whether explicitly from being talked about or just, uh, I guess, benefiting from the preparation that we do together before we have the guests. The this is all a conversation of value, because when you're talking about value, whether it's an investment or whether it's trying to take a product to market or a service, it's a conversation of values. What do we value and how do we actually work and work together? And then what are the things that each of us can do individually to become better at whatever it is that we do. And that's the reading and the writing and the speaking and the listening piece to it. That I just add that in there. We'll see you next time on
don't really
the
have any other
yeah,
comments.
the Value Investors series on the Culture Matters podcast. Thank you, Aleck Arena, for coming back. If you haven't listened,
Anytime, mate.
I don't know. He's been on here 100 times by now.
It's not often I run out of words, but today I did.
And we will see you next time on the Culture Matters podcast.
Thank you. Thank you very much.